So the next chapter which we'll be taking up for revision will be Audit of Banks. So previously, just now, we are done with revising the chapter Analytical Procedures. In fact, in the chapter Analytical Procedures, we are done with the revision of SA 520. So after this chapter Analytical Procedures, we are going to now revise the content from Audit of Banks. So once again, important chapter from the examination perspective. Compulsory question will be there from the Audit of Banks. For sure, there will be a question from this chapter Audit of Banks. But when I compare with the previous two chapters, see the immediately previous two chapters which we have revised is audit sampling we have revised, and after that analytical procedures we have revised. So when it comes to audit sampling and analytical procedures, the content of this chapters is actually very small, very limited content. So comparatively, if you compare it with other chapters, audit sampling contains limited number of questions, limited number of concepts we have revised in no time. Similarly, analytical procedures, the immediate chapter which we have completed just now, the analytical procedures is also a very small concept, limited number of questions. We are also done with that revision. So when compared with this previous two chapters, the chapter Audit of Banks is going to be a little bit bigger, not extremely bigger. So but when I do a comparison between the previous two chapters which we have revised and the chapter which we are going to revise now, Audit of Banks, is comparatively a little bit bigger. So the number of questions will be bigger. So now what we'll be doing is, as a part of this revision, we will try to cover the important content from this chapter Audit of Banks. So whatever content that is very conceptual, that is very important from the examination perspective, that we'll be focusing and we'll be trying to cover as a part of this revision. So having said that, let us directly jump into the concepts relating to Audit of Banks. First of all, what exactly this chapter will teach us? From the name itself, it is very clear. This chapter is going to teach us about how to conduct audit of banks. In case if you are getting appointed as auditor of a bank, so as we all know, the banks play a crucial factor. The banks play a crucial role in the development of any economy. Even in India, in the developing countries, the role of banks is even much higher. So what kind of activities banks will do when we call an entity as a bank? We call an entity as a banking company or bank if it fulfills two conditions. Number one, it is in the business of accepting the deposits and also giving loans. So when an organization is doing both the activities of accepting deposits and giving loans, then that entity we are going to call it as a bank. Do you think banks also require audit? 100%. Than any other organization, the requirement of audit in banks is very high. Why? Because they are dealing with the public money. And also, if you pay close attention, banks are considered as place of trust. Like for example, if you have some excess money, if I am asking you that money, so, hey, you give me the money, I will keep it safe. Will you give that money to me, or will you go and deposit it with the banker? You will definitely go and deposit with the banker. Why? Because banks carry that trust factor. And also, banks are subject to high reputational risk. If some bad news starts circulating about any bank, it creates a lot of panic among its account holders, and it will create a havoc for that customers. So that's why banks involve a lot of reputational risk, because these are the organizations which people commonly place a lot of trust on them. So if something bad news starts coming about some bank, it will have very huge consequences. So that's why, then compared with any other organization, in case of banks, the importance of audit is manifold. The importance of audit is very high in case of banks than when compared with other organizations. So in this chapter, we are going to talk about how to conduct audit of banks. But let me tell you one thing: this chapter talks very limited on audit related matters. This chapter talks more about functions and activities of the bank. In this particular chapter, even though the title is Audit of Banks, very limited number of questions you will be able to find relating to audit. More questions you will be able to find regarding the functions, operating activities of the bank. So without any delay further, let us try to understand. So first thing, as you could see here, you will be able to find something called peculiar features of the bank. What are the key features of the bank? What are the distinguishing features of the bank? How we can, what features differentiate the banks from other entities? Number one, as you could see, it involves huge volumes of transactions, and complexity of transactions is very high today in the banking system, thanks to this UPI systems and all. So today the volume of the transactions which are taking place through the banking channel is beyond our imagination, and even complexity of the transactions and the back end is getting very, very higher. And also wide geographical spread of banks network. Today banks are spread across every nook and corner of the country, and not just in the country, even our banks are having branches. Indian banks are having branches even in abroad also. And also it is having large range of products and services. Banks offer different kinds of products. In the loans itself, you will be able to find different categories of loans: home loans, personal loans, educational loans, vehicle loans. So numerous products will be there. Even in the case of acceptance of deposits, term deposit, saving deposit, fixed deposit, so numerous kinds of products and services will be offered. And they make extensive use of technology. Today the biggest users of technology, the industry which is making extensive use of technology, is banking industry. We can't imagine even a single transaction without the technology in the today's banking environment. And also strict vigilance by the banking regulator. Who is that? Strict vigilance means what? Strict monitoring. Someone is continuously monitoring that banking functions. A regulator is monitoring all the functions of the banks. So who is that regulator in our India? RBI is the regulator of that banks in India. So there is a strict vigilance by the banking regulator. So these are the important features of the bank. Now, if we talk about what are the various categories of the bank, what are the different kinds of banks, depending on the operations, whatever they are doing, depending on the people whom they are serving, depending upon the facilities they are providing, banks can be divided into 6 different categories. So those 6 different categories are: number 1, commercial banks; number 2, RRBs; number 3, cooperative banks; then we have payments bank; then we have development banks; and also small finance bank. So on what basis they have did this classification? They did this classification on the basis of functions they are performing, on the basis of activities they are doing, on the basis of customers whom they are serving. Like first talking about commercial bank. Sir, what do you mean by commercial bank? See, all the banks whatever we have today are commercial banks, which are those banks which are into the business of accepting deposits and giving loans with the intention of making profit from that differential interest component. Like for example, when they are accepting the deposits from the public, they pay interest of some 4 to 6%, but they when they give the loans to the public, they give the loans at the rate of 8% to 15%. So any bank which is into the business of giving loans and accepting deposits with the intention of making profit from that differential interest, all that will fall under commercial banks. Today all the banks are commercial banks. Then we have one more category of banks, which is regional rural banks. In short, we call them as RRBs also. Sir, what are these RRBs? The name itself says these are the banks which are incorporated to meet the banking needs of the people in the rural areas. Those banks which are incorporated to meet the to fulfill the banking needs of the people in the rural areas, that we call them as regional rural banks. So then what are cooperative banks? Cooperative banks are nothing but cooperative credit societies. See, the difference between a normal bank and a cooperative bank is, in case of a normal bank, they will accept deposit from everybody. They will give loans to everybody. There is no restriction. But what will happen in the cooperative banks is, in the case of cooperative banks, they will also accept deposits. They will also give loans, but not to the common public, but not to everybody, to only their members. There will be certain members of cooperative societies, only to their members they will give the loans and accept deposits. Like we will have some cooperative banks which will give loans and accept deposits only from the farmers. There will be certain cooperative banks which will serve the finance needs of only members who will be like small scale industries. So that is what the key difference between a normal commercial bank and a cooperative bank. The difference is normal banks will address the banking needs of everybody, but these cooperative banks, they also accept deposits, give the loans, but only to their members. Next one, payments bank. These are the recent kind of banks which are innovated. These are the recent banks which are introduced by RBI. So what are these payments bank? First, I will give you example. Today we have some new products like Paytm Payments Bank, Airtel Bank, Airtel Money. These kind of things, whatever we are saying, these are actually payments bank. Sir, what are the payments bank? Payments bank are, as you could see here, these are new type of banks which have been recently introduced by RBI. Sir, what activities they will do? They can accept only restricted deposits. Only certain amount of restricted deposits, like 2,000 rupees, this much restricted deposits only they can accept. But these payments bank cannot issue loans and credit cards. These payments bank, they will only accept deposits, that to restricted deposits, but they are not permitted to give loans and credit cards. Examples are this examples like Airtel Payments Bank, Indian Post Payments Bank, Paytm Payments Bank. So all these are examples of the payments bank. Then we have development banks. Sir, what are these development banks? See, these development banks also are those banks which will accept deposits and give the loans, but they will fulfill the banking needs of only industries which are into infrastructure development and all. Like if you see this terminology here, these banks has been conceptualized to provide funds for infrastructural facilities important for the economic growth of the country. Like for example, you will find somewhere IDBI bank. You will be able to find at various places IDBI. So if you go to IDBI, if you go to the IDBI bank, IDBI is actually a development bank. If you go to the IDBI bank and say, yeah, I am a salaried employee, I have good returns and all, so please give me housing loan. IDBI will say, we will not give you housing loan. Then why the bank is there, sir? IDBI is not there for the purpose of meeting the banking requirements of persons like you and me. They will give loans, they will provide the credit facilities to these bigger companies who are into infrastructure development, like construction companies, IT companies. So they will provide their banking facilities only to those sectors, only to those industries which are very important for the economic growth of the country. So one example is that IDBI. Then we have small finance banks. These are the banks which have been set up with the objective to meet the banking facilities of unserved or unorganized sectors of the country. So in India, we have so many unorganized sectors, like for example, matchbox industry, handloom industry. So these are the industries which are very much unorganized. When I say unorganized, they will not have proper IT returns. They will not have proper sources of income. They will not have proper recognition. So for these sectors like this matchbox industry, for like this handloom industry, it is very difficult for them to get the loans and accounts with normal commercial banks. So in order to exclusively meet the banking requirements of this unserved or unorganized sectors, another kind of banks were set up, which we call them as small finance banks. So like this, on the basis of the operations which the banks are doing, we can divide the banks into total 6 categories. Number 1, commercial banks. Number 2, RRBs. Number 3, cooperative banks. Number 4, payments bank. Number 5, development bank. And number 6, small finance bank. Next, sir, who will regulate the banking sector in India? In India, as I have told, there is a strict vigilance by some regulator. Who will regulate that banking sector? In India, banking sector is regulated by RBI. There is one regulator who is RBI. So RBI is going to regulate the banking sector. Now, how the RBI will regulate the banking sector, sir? How RBI will control the banking sector? So how RBI will regulate the banking sector is, number 1, it is a issuer of banking license. If someone wants to carry out a banking business in India, or even an existing bank want to open a new branch, they can do it only after getting license from RBI. Only after getting license from RBI. So no one can open a bank, or no existing bank can open a new branch without getting license from RBI. Number 2, RBI is a banker's bank. Sir, why it is a banker's bank? For example, if we need loan, we go to bank. What if bank needs loan? They will go to RBI. If we have excess funds, we go to bank for depositing. If banks have excess funds, where they will go and deposit? With the RBI. So that's why we call RBI as banker's bank. And even RBI is having the power to determine CRR ratio, SLR ratio. Like every bank is required to maintain certain percent of their money in specified investments, or as they have to deposit certain percentage of money with the bank, which we generally call it as CRR SLR ratios. Sir, who will determine how much percentage CRR should be there, how much percentage SLR should be there? This will be decided by whom? Once again, RBI. Next one, power to inspect any bank. RBI is having exclusive power to inspect any bank, any branch, even without giving prior intimation. All of a sudden, RBI officials can go and do the inspection of any bank. Then it will supply and control the credit. RBI, through its fiscal policies, by changing this repo rate, reverse repo rate, they will even supply the money or control the money in the economy by through their fiscal policies. And even prudential norms also will be prescribed by RBI, which means in the accounts you might have learned, in the case of banks, certain in some cases accounts are required to be classified into NPAs. In the NPAs also different categories. You will have substandard, doubtful, loss, and there is certain criteria. So when asset will be classified as substandard, when asset will be classified as doubtful, when asset will be classified as loss, and for each category of NPA, provision percentage is also mentioned. Who do you think has mentioned us all this? If it remains overdue for these many days, classified as substandard, and for substandard, create this much amount of provision. This we call it as prudential norms. Who will decide these prudential norms? Once again, RBI is going to make the decision regarding prudential norms when it comes to classification of assets and creation of provisions. And also, RBI will try to ensure good corporate governance. RBI will try to maintain good management in the banks. How RBI will try to maintain good corporate governance in the banks? They decide efficient proper criteria who can become directors of the bank. Like in any other company, just like anybody cannot become a director of a bank, RBI has given perfect criteria. Only those people who fulfill that criteria, they can only become the directors of the bank. So RBI has given specific criteria. And also, in case if the RBI feels that the transactions of certain banks are suspicious, what RBI can do is they can appoint their representative as a board of director in the board of that respective bank. Like in the S-Bank management, in the S-Bank board of directors, there are some board of directors who are representatives of RBI, who will be board of directors of S-Bank. And also in the case of RBL Bank, not RBI guys, there is a bank called RBL Bank. Even in the board of directors team of RBL, there are some representatives of RBI who has been fulfilling their functions as board of directors. So in case if the RBI finds something is wrong happening in the functions of the bank, in that bank's board of directors, they will appoint their representatives. So this is how RBI is going to regulate the banking sector. In these many ways, they will regulate by issuing banking license, they act as a banker's bank, they determine CRR, SLR, they have power to inspect any bank, they are a supplier of money and controller of credits, they determine prudential norms, and they ensure the good corporate governance. Clear? Next, sir, what is a regulatory framework? Regulatory framework means nothing but what laws and regulations will become applicable for the banks. In case if you want to run a bank in the country, it is not going to be an easy task. There are numerous laws and regulations which you are required to comply with. The list of laws and regulations are given here. There is no concept, so just list is there. Like banks have to comply with Banking Regulation Act, they have to comply with RBI Act. If it is a company, they have to comply with the Companies Act. For SBI, there is altogether a separate act, SBI Act we have. Then we have Banking Companies Acquisition and Transfer of Undertakings Act, and then we have SARFAESI Act. Then we have something called RRBs. For RRBs, separate act is there. Our Regional Rural Banks Act is there. And also information technology. Since today banks are making extensive use of technology, even they are required to comply with Information Technology Act, and even prevention of money laundering. Nothing but banks should be prevented from doing Hawala transactions and all. To punish the banks in these cases, even PMLA Act is also there. Credit Information Companies Regulation Act. Today banks are offering credit scores and all. To regulate that credit score mechanism, we have this Credit Information Companies Regulation Act, and even Payment and Settlement System Act. So like this, banks are required to work under strict regulatory environment. These many laws and regulations the banks have to comply as a part of their day-to-day operation. So if they ask you the question, what is a regulatory framework? In the case of banks, you have to reproduce all this laws. Next, on the basis of level of computerization, banks are divided into three categories. On the basis of usage of information technology, on the basis of computerization which has taken place in the case of banks are divided into three categories: non-computerized, partially computerized, fully computerized. The name itself says non-computerized. Those banks which are still doing their transactions in a manual way without usage of systems, that we call it as non-computerized banks. Today we don't have any such banks in our country. Then we have fully computerized. What is fully computerized? Those banks which are completely relying on the technology, and they make use of softwares like core banking solutions. CBS means core banking solutions. Those banks which are completely doing their operations with the help of a robust software mechanism like core banking solution softwares, those banks we are going to call them as fully computerized banks. Today most of the modern day banks are fully computerized. Like you take Axis Bank, ICICI Bank, HDFC, these are all fully computerized banks. Then we have in between one category, partially computerized banks, which means what? Only a few transactions are computerized while major transactions are happening in a non-computerized manner. That means half. So only some transactions are computerized, some other transactions are happening in a manual way. We have some banks in India under this category, some cooperative banks are there which are still falling under that partially computerized banks. But in India, we don't have now this non-computerized banks in India. Clear, everybody? Able to understand? So we are done with 4 concepts from this Audit of Banks till now. Let us now proceed further with the remaining concepts from this chapter, Audit of Banks. So question number 5 is going to be very important. This is the question in which most of the times the question has been tested in the examination. So this is the major question from which majority of the cases you will be able to find the question from this particular chapter. So what is this question number 5 about? Question number 5 actually talks about special NPA norms in case of some special cases. So generally we have basic NPA norms. If the account remains overdue for more than 90 days, classified as substandard. So all that things classified as NPA and all. So those are actually regular NPA norms. But here they have mentioned some 8 special cases where NPA norms are going to be a bit different. Regular NPA norms we don't follow. We follow different NPA norms in 8 special cases. So what are that 8 special cases they have listed down here? So let us try to understand what are that 8 special cases and what will be the NPA norms in case of that 8 special cases. We'll try to understand that. So very important question, guys. At least one point they will pick, at least one case they will pick and they will pose it as a question. So let us try to proceed ahead. First case, accounts regularized near about the balance sheet date. So what is this accounts regularized near the balance sheet date? So regularized means made good. What do you mean by regularized? Made good. So accounts which are made good close to the balance sheet date. See, generally we know that if an account remains overdue for more than 90 days, that account has to be classified as NPA as per the regular rules. But bank managers, especially branch managers, don't want to classify their accounts as NPA, don't want to classify the accounts in their branch as NPA. Why the branch managers don't want to do this is, in case if there are more accounts in their particular branch which are classified under NPA, that means that branch performance is not good. If the branch performance is not good, then that concerned branch managers and the bank staff will not get the increments as expected. So what some managers will try to do is they will try to play some cheap tricks. What exactly they will try to do is an account will remain overdue for more than 90 days. But in order to avoid classification of that into NPA, an account will remain overdue, but in order to avoid that account from being classified as NPA, what they will do is close to the balance sheet date, they will try to record fake credit entries. They will record as if the payment has been received close to the balance sheet date. In the last 5 days of the balance, in the last 5 days of the financial year, they will record a payment entry. But actually customer will not pay, the bank staff will do it. Why, sir? If you record an entry, then an account will not remain overdue for more than 90 days, then NPA will not be that account will not be classified as NPA. Then what they do is immediately after the closure of the financial year, in the next year they will reverse that entry. So some managers will try to play these cheap tricks in order to avoid the accounts from being classifying it as NPA, so that branch performance will be good, so that they will get increments as expected. So those kind of accounts, I call them as accounts regularized near about the balance sheet date. You have to be very careful while verifying these accounts. In case if you find that there is one entry close to the balance sheet date, if you have any suspicion, you have to inquire that into detailed manner. In case if you found that that entry was fake credit entry, you should ask the concerned manager, no sir, I will not accept this as a valid entry. You have to classify it as NPA. In case if the branch manager is not accepting to classify it as NPA, you have to give a modified opinion. Able to understand? So that's all even they try to say here. So what do you mean by accounts regularized near about the balance sheet date? These accounts with a few credits received just before the balance sheet date. Immediately close to the balance sheet date, you are receiving the few credit entries. These accounts should be handled with care. If the account indicates inherent weakness, you should insist that the account should be deemed to be a NPA. You should insist the management, no, I will not accept this classification. You have to classify it as NPA. Sir, what if the branch manager doesn't agree? Give a modified opinion. Next one, government guaranteed advances. Now, sometimes what will happen is customers will come to the bank, they will ask for the loan, they will give the loan. For example, SBI has given a loan to some company X Limited, but it is a central government guaranteed advances. What do you mean by central government guaranteed advances? The bank has given the loan to X Limited, and the central government is giving a guarantee that in case if X Limited fails to repay the loan, we central government will repay the loan to you. So that is what the meaning of central government guaranteed advances. Some customer has taken the loan, but central government stood as a guarantor for that loan. So generally, when the account remains overdue for more than 90 days, it will be classified as NPA. But that rule doesn't apply here in the case of central government guaranteed advances. So Banking Regulation Act told that in case if there is a central government, in case if the advance is guaranteed by central government, even though the account remains overdue for more than 90 days, it will not be classified under NPA. It will still remain in the standard category only. Why? Because central government guarantee is there, no? So that's why Banking Regulation Act told the banks, in case if there is a central government guaranteed advances, even though if it remains overdue for more than 90 days, you need not classify it as NPA for asset classification. That means for asset classification, it will remain in the standard category only, but income recognition will happen treating it as NPA. That means even though if the central government guaranteed advances is kept under standard category, we will recognize the interest income only on cash basis. Generally, in case of standard asset, you can recognize the income on accrual basis, but this is a special case. In the case of central government guaranteed advances, that advance for asset classification, it will remain in the standard category only, but for income recognition, it will be treated as NPA. That means even though this particular advance will remain in the standard category, income will be recognized only on cash basis, not on accrual basis. Sir, what if the state government has given guarantee? In case state government, if the advance is guaranteed by state government, then there is no special treatment. It will be treated, it will be classified under normal NPA norms only. So if the state government has given guarantee, no special privilege. Only the special privilege is there when the guarantee has been given by central government. Next one. Third point is about advances under consortium. First of all, we have to understand what do you mean by advances under consortium. Sometimes we also call it as consortium advances. So what exactly is the meaning of consortium advances? Take for example, Reliance Industries Limited. It has approached SBI. Sir, dear SBI, we need 1000 crore rupees of loan. We need 1000 crore rupees of loan. SBI knows that Reliance Industries Limited is a reliable customer. They have a repaying capability. They want to have the business relationship, but they don't want to take this much exposure. They want to take entire 1000 crores of risk. So SBI is ready to give 600 crores of loan, but Reliance Industries Limited is asking for 1000 crores of loan. So now what SBI has done is it has approached the other banks. For example, it has approached ICICI Bank, and they have convinced the ICICI Bank to give 200 crores of to give some 100 crores of loan. Okay, let us take 200 crores of loan to Reliance. Then they have approached some Axis Bank, and they have convinced Axis Bank to give 100 crores of loan. They thought PNB is suffering losses. Let us help the PNB also. They went to the PNB and make them accept to give 100 crores of loan. Now SBI, along with all the 4 banks together, they have formed a group. That group we call it as consortium. And as a group, they have handed over the loan of 1000 crore rupees to the Reliance Industries Limited. So now this we call it as consortium advances. This kind of advance we generally call it as what? Consortium advances, where a group of banks collectively give a loan to the customer. And in case of consortium advances, there will be generally one bank which will take the leadership, which we call it as a lead bank. Generally, lead bank will be that bank which is having a highest share. In our given case, since SBI is having a highest share, SBI will be lead bank. Remaining banks will be member banks. See, generally how the repayment will happen. In the case of consortium advances is there will be two options. Number one, the customer, Reliance Industries Limited itself, will determine what is the amount of installment for each and every bank separately. For example, 100 crores of installment they have to pay. So now they will determine what is the amount of installment for each bank separately. They have decided 60 crores should go to SBI, 20 crores should go to ICICI, 10 crores should go to Axis, and the 10 crores should go to PNB. Generally, what will happen is Reliance Industries Limited itself will make deposit of the amount with the respective banks on the due dates. In that cases, in case if one branch did not receive the payment, that bank will classify that particular account as NPA. In this case, there is no problem. When the customer is making the payment separately to each and every bank, there is no problem. But when the problem arises is, in some consortium advances, the agreement will be like the customer will pay entire installment amount to lead bank. In our case, lead bank is SBI. So customer is paying entire 100 crore rupees of loan to SBI. Now, what lead bank should do is they have to keep their share. How much? 60 crores they have to keep their share, and balance amount they have to transfer it to members bank. For example, after keeping 60 crores, 20 crore rupees they have to transfer it to ICICI, 10 crore rupees they have to transfer it to Axis Bank, 10 crores they have to transfer it to PNB. But some cases what will happen is customer will make the payment of entire amount to lead bank, but lead bank will not transfer the share to member banks. Lead bank will not transfer the share to member banks. In case if the member bank has not received the payment on the due date and it remains overdue for more than 90 days, now what ICICI Bank will do is it will classify Reliance Industries Limited account as NPA. Why? Because they did not receive the payment. No. But do you think here Reliance mistake is there? No. Without their fault, they have made the payment of 100 crores to SBI. It is whose default? Lead bank's default. But even because of the lead bank's default also, unnecessarily customer account is getting classified as NPA. So in these cases, what they have given the permission is, in case if the members bank did not get the payment, at least if they get a confirmation from the lead bank that they have got the payment on behalf of the customer. That means customer has made the payment to the lead bank, but they are yet to transfer the money to the members bank. In that case, even though they did not receive the money, still they need not classify them as NPA. Why? Because here customer is honest, he has made the payment to lead bank. In case if you get confirmation, as a member bank, you did not get the money. But in case if you are able to get the confirmation from the lead bank that they have received the money on their behalf, then NPA classification could be avoided. So this is what the NPA norms in case of consortium advances. Very simple, guys. But these kind of repayments, very rarely it will be followed. In 90% of the cases, consortium advances will have this kind of repayment structure where the customer himself will deposit the proportionate amount to each and every member's bank, each and every bank in the consortium. In that case, no issue at all. When the problem arises is customer is transferring the money to the lead bank, but lead bank is not transferring the share to the members bank. In that cases, there should be proper communication happening between lead bank and member bank. In case if the member bank got the confirmation that the lead bank has received the money on their behalf, they can avoid the NPA classification. Clear? Next one. So this is the third case. So three cases we have seen. Number one, accounts regularized near about the balance sheet date. Then we have also seen about government guaranteed advances. Then we have seen advances under consortium. Now let us talk about accounts where there is a erosion in the value of security. Sir, what do you mean by erosion? Reduction in the value of the security. As we know, generally when a customer, when he goes to the bank for the purpose of loan, banker will give the loan only after asking for security. No banker will give you the loan looking at your face. For example, assume that I am a person, I need a loan from the bank. I have a property worth 1 crore rupees. So if I keep my 1 crore worth of property as a security, the banker will give loan. And you always know that the banker will not give the loan not even equal to the amount of security. They will always give the loan amount less than the value of the security. Assume that you have deposited the property worth, you have given 1 crore worth of property as a security and the bank is giving you only 80 lakh rupees. So the value of the security should always be higher than the amount of loan given. The difference we call it as margin. The excess of that value of the security over the loan amount, that we call it as margin. So in the given case, value of the security is 1 crore. Whereas the amount of loan given is 0.8 crore. So excess of the value of the security over the loan amount is 20 lakh rupees. This 20 lakh rupees, we call it as margin. Banks always keep that margin. So you are a customer, you have given your property as a security and the banker has given you loan of 80 lakh rupees. But sometimes what will happen is after you have given this particular asset as a security, there might be erosion in the value of the security. There might be what? Erosion. Sir, what do you mean by erosion? There might be reduction in the value of the security. Take for example, whatever building that you have given as a security, in that locality there was a accident, there was some earthquake, because of that building got demolished. The value of the security will be reduced. So in that cases, what NPA norms will be applicable? In case the asset, whatever you have offered as a security for the purpose of loan to the banker, if there is a reduction, if there is a erosion in the value of the security, if there is a permanent reduction in the value of the security, then it will have a hit on NPA norms. How NPA norms will change? Let us see. So as a doubtful asset, so erosion means gradual reduction or diminution of something. And in case if there is a erosion in the value of the security, in some cases we have to classify it as a doubtful asset. In some cases we have to classify it as a loss asset. So when we will classify it as a doubtful, when we will classify it as loss, let us see it. If the realizable value of the security is less than 50% of the value assessed by the bank or accepted by the RBI at the time of last inspection, such assets may be straight away classified under doubtful category. So what they are telling, if the realizable value of the security is less than 50% of the previous value of that asset, less than 50% of the previously assessed value. Like if you take here, the value of the security was 1 crore. Previously, the value of the security was 1 crore. Now, 50% of that value of the security means it will be 50 lakh rupees. Now, if the realizable value of the security is less than 50% of the previously assessed value, the previously assessed value was 1 crore. Because of diminution, because of erosion, the value of the security has come to less than 50 lakh rupees. For example, assume that if the realizable value of security is only 30 lakh rupees now. After that earthquake and all, that value of the property has become only 30 lakh rupees. So now the realizable value of the security is less than 50% of the previously assessed value. Then this entire 80 lakh rupees will be classified under doubtful category. Sir, when we will classify it as a loss asset, sir, if the realizable value of the security as assessed by the bank or approved valuer or RBI is less than 10% of the outstanding in the borrower's account. In case if the realizable value of the security is less than, 10% of outstanding amount, here you have to pay very close attention. Very, very important point, highly important for MCQs and true or false statements. So here if you see here, for the purpose of doubtful asset, we have to compare the realizable value with previously assessed value. For the purpose of loss asset, we have to compare the value of the realizable value of the asset with outstanding amount in the customer's account. So outstanding amount, take for example, 80 lakh rupees is the outstanding amount. 10% means how much? 8 lakh rupees. So 10% of 80 lakh rupees of outstanding amount, which will come to 8 lakh. If the realizable value of the security is even less than 8 lakh rupees, for example, after that earthquake and all, now the value of the property is only 5 lakh. So since the realizable value of the security is less than 10% of the outstanding amount in the customer's account, then this entire 80 lakhs will be classified as loss asset and 100% of provision has to be created. Able to understand? Clear and comfortable, everybody? So this is what NPA norms in case if there is a erosion in the value of the security. Erosion means reduction in the value of the security. So if there is a reduction in the value of the security, we have to either classify it as doubtful or loss. When doubtful, if the realizable value of security is less than 50% of the previously assessed value. On the other hand, if the realizable value of the security is less than 10% of the outstanding amount, then as a loss asset. Next one, advances against term deposits, NSAs, KVPs or IVPs. So sometimes what will happen is customers will come and take the loan, and for that loan they will offer security as NSP, National Savings Certificates, Kisan Vikas Patras, Indira Vikas Patras, or fixed deposits. So these kind of assets, they will give it as a security and they get the loan from the banker. For example, a customer came, he's having fixed deposit worth 1 crore rupees with the bank. He offered that fixed deposit as a security and he got 80 lakh rupees of loan. Generally, if this account remains overdue for more than 90 days, it has to be classified as NPA. But what they say is, in respect of these assets, in case if the customer has taken loan, giving security as fixed deposits, NSAs, KVPs or IVPs, even though they remain overdue for more than 90 days, no need to classify them as NPA. Provided the condition is adequate margin should be available. What should be available? Adequate margin in that account should be available. What is margin? Just in the previous case I have told, the excess of that value of the security over that loan amount, that we call it as margin. Till the time adequate margin is there, that account need not be classified as NPA. Sir, why this provision has been introduced? Why? Because fixed deposits, NSCs, KVPs and IVPs, these are risk-free investments and can be readily converted into cash. Here banks carry very lower risk. So take for example 80 lakhs of loan he has taken, 1 crore of fixed deposit he has given. He did not pay the installment. He did not pay. So interest accrued is 8 lakh rupees. So total amount outstanding is 88 lakh rupees. He did not pay the amount for more than 90 days. Is it required to be classified as NPA? No, not required. Why? Because there is still margin available. 1 crore is the security amount. 88 lakh rupees is outstanding amount. 12 lakh rupees of margin is there. No need to classify it as NPA. Now next year also interest accrued. For example, next year also 10 lakh rupees of interest accrued. Now it became 98 lakh rupees of outstanding amount. Value of the security is 1 crore. Is it required to be classified as NPA? No. Why? Because still margin is available. Still 2 lakh rupees of margin is available. Next year on this 98 lakh rupees, some 12 lakh rupees of interest accrued. It become 110 lakh rupees. Value of the security is 1 crore only. Now margin has evaporated. Now there is no margin. Now this has to be classified as NPA. So till the time adequate margin is available, you need not classify that particular account as NPA. Understood? Next one. Now we will talk about agricultural advances. See, as we know, in the case of agricultural advances, NPA norms are going to be a bit different. Here we don't follow more than 90 days or all that conditions. In case of agricultural advances, NPA norms will be different. So for the purpose of NPA norms, we will classify agricultural advances into two categories. Agricultural advances given for long duration crops, agricultural advances given for short duration crops. Sir, what are agricultural advances given? First of all, what are long duration crops? Those crops which take a crop season of more than 1 year, that we call it as long duration crops. On the other hand, those crops which take a crop season of less than 1 year, we call it as short duration crops. What is crop season? Crop season means simply from the date of sowing the seeds till the date of harvesting. If the time period is, or whatever time period is that we call it as crop season. So if certain crop is taking a crop season of more than 1 year, that we call it as long duration crop. Other crops we call it as short duration crops. Bank might have given loan for long duration crops, or bank might have given loans for short duration crops. In case if the advance is given for long duration crops, that has to be classified as NPA only if it remains overdue for more than one crop season. More than one crop season. For example, if a crop is taking 13 months of duration, so and the bank has given loan for this crop, this loan has to be classified as NPA only if it remains overdue for more than one crop season. From the due date, if it remains overdue for more than 13 months, then only it will be classified as NPA. On the other hand, if the banker has given loan for short duration crops, that will be classified as NPA only when it remains overdue for more than 2 crop seasons. For example, if certain crop is taking 4 months of duration, then that loan will be classified as NPA if it remains overdue for 2 times of the crop season. That is, if it remains overdue for more than 8 months, then only it will be classified as NPA. So the NPA norms are going to be a bit different in the case of agricultural advances. Clear, everybody? So say short duration crops, a loan will be treated as NPA if the installment remains overdue for more than 2 crop seasons, whereas long duration crops, it will be treated as NPA if it remains overdue for more than 1 crop season. Understood, everybody? Now most important thing is who will decide the crop season. Sir, what will be the crop season for each crop? Will it take 4 months, 5 months, 9 months, 10 months? Who will decide that crop season? Banker or farmer? Neither the banker nor the farmer. So that crop season has to be decided by state level bankers committee. In each state there will be someone called state level bankers committee. In that committee, bankers also will be there, farmers representatives also will be there. They will decide the crop season. That decision will be final. State level bankers committee will decide. Then we have agricultural advances affected by natural calamities. Sometimes banks will give loan to the farmers, but the crop will be affected by natural calamity because of floods and all. Crop will get affected. So if the crop is affected by natural calamity, will the farmer be able to give the loan? No. If the crop is affected by natural calamity, farmer will not be able to give the loan. He will not be able to repay the loan. Then what will happen? In that case, RBI has given power to banks to take relief measures. In case if the bank has given the loan to the farmer and the crop was affected by natural calamity, then the banks can take some relief measures. What kind of relief measures they will do? For example, they will extend the due date. They will convert the short-term loan into long-term loan, or they will give a new loan and collect the old loan and new loan after the new crop comes to hand. So whenever crops are affected by natural calamity, banks can take these kind of relief measures. Either they can extend the due date, or they can convert the short-term loan into long-term loan, or they will give a fresh loan and collect both the loans together. So when the relief measures are taken by this bank, in those cases, NPA norms will be decided on the basis of revised norms, not as per original norms. For example, earlier at the first time when the loan was given, due date is 31st of January. But the crop is affected by natural calamity. Because of that, banker has taken a relief measure. They have extended the due date to 31st of March. Now, if the amount is not paid as on 31st of January, which is previous due date, it will not be treated as NPA. Old norms will be ignored. What is the new due date? 31st of March. If the amount remains overdue after 31st of March, then only it will be classified as NPA. So simple thing is, in case if any relief measures are taken, NPA classification would be governed by rescheduled terms, not the original terms. Then we have one more point, advances to staff. See, sometimes what the banks will do is banks will give loans to their employees also. For example, SBI bank manager is there, he need a housing loan. So what he has done is, this employee of SBI, he approached his employer only, SBI, and he asked the SBI to give the housing loan to him. So in these cases, the bank has given loan to its employee. That in case if the bank has given loan to its employee, will there be any special NPA norms available? No. The answer is no. Even if the bank has given a loan to its employees also, still no special NPA norms will become applicable. Whatever norms that are applicable in regular cases, same NPA norms will be applicable even if the loan has been given to employee. In case of normal housing loan, account will be classified as NPA if it remains overdue for more than 90 days. Same NPA norms will be followed even in the case of employees also. Understood? That is what the summary of this G point. Clear? So these are the 8 special cases where we have to be a little bit careful about NPA norms. Hope you guys have understood this. So let us now proceed further with the next concept from this chapter. So the next concept which we will be revising is, what are the different nature of securities which will be accepted by the bank, and what are the various modes of creation of the securities. See, just in the previous concept, as I was telling, whenever you approach the banker for the purpose of the loan, the first thing which the banker will expect from you is what security you are accepting. So now this particular question is revolving around the concept of the securities. One question is, this part actually involves 2 concepts. Number 1, what are the nature of the securities, and what are the various modes of creation of the security. So talking about the nature of the securities, we can divide the securities accepted by the bank into 2 broad categories. Number 1 is either a primary security or collateral security. So what is this primary security? What is this collateral security? Very simple. Primary security means the main asset which you are offering as a security for the purpose of the loan. So that only they call it as the principal asset, the principal security which is given for the loan, that we call it as primary security. Take for example, I went to the banker, I told I needed a loan of 10 crore rupees, and the banker asked me for the security. I told I have a factory building, that factory building I will give it as a security. Again, is that you give me the loan. So here, factory building is a primary asset which has been given as a security. It is a principal security. So that we call it as primary security. So then what is collateral security? Collateral security is, in addition to principal security, in addition to main security, sometimes bankers will ask you to keep some additional security. Take for example, banker is telling, okay, I will take factory building as a security, but I want something extra. Then I told, okay sir, keep this factory as a primary security, I will give my stock as a collateral security. So something which you are additionally offering in addition to the main security or principal security, that we call it as collateral security. And what kind of assets can be accepted as securities are? Different kinds of assets can be accepted as security. So that could be in the form of immobile property, that could be your current assets like goods, stock, debtors, trade receivables, or it could be gold ornaments or bullions. It could be plantations. For agricultural advances, what will be the security? The crop which the farmer is going to get, that is going to be the security. Third party guarantees, or even LIC policies, personal security of guarantor, and even stock exchange securities like shares and debentures also can be accepted as securities. So these are the different categories of assets which can be accepted as securities by the bank. So one part of the question we have answered, what are the nature of securities. Now let us address the next part, which is talking about what are the various modes of creation of security. So when it comes to various modes of creation of security, so in the material, in the ICS study material, they have given that there are 6 modes of creation of security. How many modes of creation of security are there? 6 modes of creation of security are there. But I do personally feel that out of that, 4 are only actually modes of creation of security, 2 are actually modes of settlement. But don't write all these things in the examination. When they ask you the question, what are the various modes of creation of security? As per the ICA material, we have 6 models actually, 6 modes of creation of security. But actually, practically speaking, out of that, 4 are only the modes of creation of security. The last 2 are actually modes of settlement. But anyhow, let us try to understand what are the various modes of creation of security. So the things which they say it in the things which they have mentioned is, number 1 is mortgage, number 2 is pledge, number 3 hypothecation, number 4 assignment, number 5 we have set off, number 6 we have lien. So these are the 6 modes of creation of security. So repeat everybody, what are the 6 modes of creation of security? Number 1 mortgage, number 2 pledge, number 3 hypothecation, number 4 assignment, number 5 set off, and number 6 is lien. So let us try to understand each and everything in a detailed manner. Sir, what exactly is this mortgage? So what happens in the mortgage? See, the term mortgage will be used when immovable properties are given as security. When what is given as security? When immovable property is given as security, so that we are going to call it as mortgage. For example, land and buildings, when these assets are offered as security, we call it as mortgage. And that mortgage also will be of 2 types. Number 1 is registered mortgage and the other one is equitable mortgage. Sir, what is registered mortgage, sir? For example, I need a loan from the banker. I have a immovable property, so I want to give it as a security. Here what I will do is, with the banker, I will enter into one deed. I will create one mortgage deed. So in that deed I will mention I am the owner of this building, but for the purpose of loan I am giving this as a security, and in case if I don't repay the loan, bank will have the right to take my property. So I will enter one, I will take one stamp paper, write it on that these terms, so that we call it as a mortgage deed. So that is registered mortgage. There will be other kind of mortgage where all this deed and all will not happen. So what I will do is, if I am the owner of the immobile property, so that original documents of the immobile property will be there. No, that original documents I will keep it with the banker, and the banker will give me back my original properties when I repay the loan. So these are the two popular modes of creation of mortgage. Number one, registered mortgage, where I will enter into a mortgage deed, whereas we also have equitable mortgage. In that case, we don't have any deed or anything. The original documents which I am supposed to have, that I will go and keep it with the banker, and the banker will give back that original documents to me once I repay the loan. This I call it as mortgage. Now, the two other popular modes of creation of security are one is a pledge and the other one is hypothecation. See, both the terms pledge and hypothecation are used when movable assets are given as security. When what is given as security? When the movable assets are given as security, we use the term pledge and hypothecation. In both the cases, the asset being offered as security will be a movable asset. So if in both the cases a movable assets are given as security, then what is the difference between the two? Pledge is the case where the possession of the movable assets will be transferred to the lender, that is in our case banker. Whereas in the case of hypothecation, neither possession nor ownership, nothing will get transferred to the banker. Both will remain with the owner of that asset only. So pledge, best example, if I have to give jewelry loans, if you want to go to the bank and get the jewelry loan, so if you want to give the jewelry as a security, what the banker will say? He will ask you to deposit that jewelry with the banker. That means possession of that jewelry will be there with the banker. You will not be allowed to keep that jewelry. So you have to deposit that jewelry with the banker until the time you repay the loan. That jewelry will be in the possession of the banker. Once you repay, you can get back that possession. For hypothecation, if I have to give an example, vehicle loans. For example, if you take a vehicle loan, the vehicle will be there with you only. Possession will be there with you only. In case if you don't repay the loan, then that financier will come and take that vehicle. Yes or no? And one more thing, even when you give stock as a security, when you offer stock as a security, if you are hypothecating the stock, so for example, if you have taken working capital loan giving your stock as a security, does that mean you will take all your stock and keep it with the banker? No. If you keep it with the banker, how you will do the business? Stock will be there in the possession of the borrower only. In case if I don't repay the loan, then the banker can come and collect my stock. So that we call it as hypothecation. That is the main difference. In pledge, possession will get transferred to the banker. In hypothecation, neither possession nor ownership, nothing will get transferred to the banker. So this is the major difference between pledge and hypothecation. Then we have the fourth method of creation of security, which is assignment. Assignment. The term assignment will be used when mainly actionable claims are given as security. When what is given as security? When actionable claims are offered as a security, then we use the term assignment. Like if you are giving your trade receivables as a security, if you are giving your debtors as a security, if you give your LIC policies as security. So these are the cases of assignment where actionable claims will be offered as a security. That mode of creation of security, we call it as assignment. And as I have told in the middle, they say total 6 models. The last 2 models are, number 1 is set off and the other one is lien. Sir, what is this set off? What is this lien? Very simple. For example, there is a bank, there is a SBI. Okay, so one person is there, he has taken a loan from SBI, he has taken 10 lakhs worth of loan from SBI, and with the same SBI he is having FD also. He has deposited certain amount of money with the SBI, and whatever loan he has taken from the SBI, if he did not repay, if he is not repaying that loan, do you think the banker will have right to adjust the liability of the loan again as a fixed deposit? See, this customer has kept fixed deposit with the SBI. No. Do you think the bank will have right to adjust this loan against a fixed deposit? Yes, they can do it. This right available to the bank, we call it as set off, where the liability of a person can be adjusted against the asset of the person, provided both the accounts, both the asset and liability are in the name of the same person and in the same capacity. If both are there, then it can be adjusted. That only we call it as set off. So you tell me, is it mode of creation of security? No. See, set off will happen after the loan has been given. When the payment did not receive, then the banker will exercise set off. That means it is actually a mode of settlement. It is not a mode of creation of security. But in the ICS study material, as I have told, even this also they have added it under mode of creation of security only. Then we have lien. Lien we already know. Lien means what? Retaining the possession of the goods. In case if the borrower did not repay the loan and if the banker is having the possession of some of the customer's goods, he can sell them and realize the money. So that we call it as lien. Lien is also something which is a mode of settlement only. Understood, everybody? So these are the 6 different modes of creation of security, very important from the examination perspective, and there are high chances the question might be tested as case scenario based MCQ from these particular concepts. Understood? Clear, everybody? So let us now try to proceed further. So we are done with security related question also. So now we will talk about the next most important question, how to conduct audit of drawing power of advances. Sir, what is this drawing power? So drawing power is the term which is mainly associated with working capital borrowings, especially with cash credit facilities and overdraft facilities. This drawing power is associated. Sir, what exactly is this drawing power? See, generally, when you go to the banker and ask for working capital loan like cash credit or overdraft facility, for this also the banker will ask you security. So for that, what we generally offer it as security for working capital loans, what we give as security, current assets, we give it as security. When I say current assets, our inventory, our debtors, these are the assets which we mainly give it as a security. So take for example, on one particular day, there is company X Limited. It approached the banker for the purpose of working capital loan. They needed some cash credit facility. Now what the banker will ask you is, okay sir, we will give you loan. You please bring your stock statement and debtor statement. So what the company has done is they have prepared one stock statement. So as on so and so date, for example, they are approaching the banker for the purpose of loan on 1st of January 2024. So when they're approaching the banker for the purpose of loan, they have taken the stock statement. They have determined the value of stock as some 10 crore rupees is the value of stock. So this stock statement they have submitted, and the banker thought, okay, you have very good stock position, we will accept this stock as a security, and here stock will be hypothecated. Hypothecated means what? The stock will remain in the borrower's possession only. So just they will submit this stock statement, and the bank told, okay sir, since you have 10 crores worth of stock, we will sanction cash credit or OD of 8 crore rupees. They will sanction you 8 crore rupees. But once they have sanctioned the OD facility, they will not let you use the entire amount. They will put one more limit. They will put what? One more limit, generally equal to the sanction limit or lower than the sanction limit. They will put one more limit called drawing power. For example, banker is telling, on the basis of your stock statement, we will sanction you 8 crore rupees of OD facility, but we will let you withdraw only 7 crore rupees. So this we call it as drawing power. Drawing power means the maximum amount which can be withdrawn from the working capital loans. That we call it as drawing power. So that is what the meaning of drawing power. If you see that in the material, drawing power generally addressed as DP is an important concept for cash credit facility availed from the banks and financial institutions. Drawing power is a limit up to which a firm or company can withdraw from the working capital limit sanction. They will sanction you the limit, and below that limit, generally most of the banks today, they are keeping the drawing power equal to the sanction limit, but some banks will even keep it below the sanctioned limit, certain another amount, which we call it as drawing power, which is the limit up to which maximum you can withdraw the money. So that we call it as a drawing power. And drawing power is different from sanction limit. Sanction limit is different, drawing power is different. Sir, now how this drawing power will be calculated, sir? See, this drawing power will be calculated on the basis of the stock statement. Okay, initially the borrower submitted the stock statement. On this basis, they have sanctioned the drawing power of 7 crore rupees. But as we all know, stock is something which will not remain constant. Stock will keep on changing depending upon the business done. The stock will keep on changing. So now how the banker will come to know the status of the stock? How the banker will come to know the status of the stock is the borrower has to periodically submit the stock statement with the banker. After taking the loan, the borrower has to submit periodical stock statement. Generally, RBI told the banks should get stock statement at least once in a quarter. You should get the stock statement at least once in a quarter. So quarterly, he will submit the stock statement. For example, on 31st of March 2024, the borrower will submit the stock statement. On that date, he determined the stock value, and he came to know that the stock value was 9 crore rupees only. Now this stock statement will be received by the banker. Now what the banker will do is, on the basis of the recent stock statement, he will revise the drawing power. Earlier, at the time of loan, since the amount of stock value was 10 crore rupees, he gave a drawing power of 7 crore. Now what he will do is, since the stock amount has fallen, he will reduce the drawing power. Now he will give a drawing power of 6 crore rupees only. He will reduce the drawing power. Like this, once again, next quarter, he will submit once again the stock statement. Now on the basis of the stock statement received by the banker will once again revise the drawing power. Either he will increase or reduce it on the basis of the stock position. On the basis of what? Stock position. And how this drawing power will be calculated? Generally, every bank's board of directors will have certain rules. Some banks will say that they will give 60% of the stock as drawing power. That means, for example, if someone submits a stock statement of 100 crore rupees, out of that 60% only they will give the drawing power. That is 60 crores they will give the drawing power. Some board of directors of the banks will have decided that they will give only 50% of the stock as drawing power. Some banks may go to some another level. They might take extra risk. They will say they will give 80% of the stock value as drawing power. So like this, every bank's board of directors will have certain rules. According to that rules, drawing power has to be calculated. And there is one format for calculation of the drawing power. Let me show you that format for calculation of drawing power. So one of the past examination question. So the format for drawing power is something like this. So I will write it here. The format for how the drawing power will be calculated. So generally you have to take stock. From that you have to reduce creditors. So the balance thing which you will get it as paid stock, that we call it as paid stock, we call it. So here also you'll be able to find that in the material. You can use it, or else this format also you can see paid stock. Generally, as I told, every company will have certain margin. For example, if the bank's policy is 20% margin for stock, that means they will give 80% only as loan. Margin means that much portion they will not give. Some banks will have 30% margin. 30% margin means they will give only 70% of the stock as drawing power. So in the question they will mention what is the margin for stock. Example, in the question they have told that margin for stock is 20%. So that value I have to reduce minus margin. That means banker doesn't want to take that 20% risk. So now I have to reduce margin at the rate of 20%. On this figure, I will multiply 20%. I will get the value. The balance amount will be drawing power for stock. Say A. Now, similarly, for debtors also you will get the drawing power. So you have to take debtors. From the debtors, you have to reduce those debtors which are overdue. See here, those debtors which are overdue for more than 90 days. Sorry. So you have to take out debtors overdue for more than 90 days. So that debtors you have to take it out. So you will get some figure. Eligible debtors you will get. You will get what? Eligible debtors. So from this eligible debtors, they will say in the question margin for debtors is 30%. So now what you should do is whatever margin they have given in the question, that margin percentage you have to apply. Margin at the rate of 30% you have to apply. So if you take out that margin, balance whatever you get, that we call it as drawing power for debtors. That we call it as what? Drawing power for debtors. Say B. Now what will be total drawing power? Total drawing power is going to be A plus B. So if you add drawing power for stock, drawing power for debtors, you will get the total drawing power. One of the past examination question. They have tested this in the examination. So I have even given the question here. So even I have given it here. You can solve it. You can use it for the purpose of your calculation. Understood everybody? To get the feel of it, you can use this. Clear? So this is what the format for calculation of drawing power, and once again I'm telling it is one of the past examination question, so this has been tested. So this is what the format. You can even take the help of that illustration whatever has been given in the study material. So what is the bank's duty with regard to drawing power? They have to get quarterly stock statement. They have to check that calculation has been done as per bank's rules and regulations and all, and the bank's management should make sure that all the accounts are within the drawing power. No account should go beyond the drawing power. If any account goes beyond the drawing power, that is something going wrong in the organization, that should be brought to the notice of the head office. So no account should go beyond, the usage in any account should not go beyond the drawing power or sanctioned limit. So these are the few banks duties which banks have to fulfill regarding drawing power. Next, what auditor should do? What auditor should do is the auditor should verify all the stock statements, quarterly returns and other statements on the basis of which loan has been, on the basis of that working capital has been given. He has to verify all the supporting documents against which loan has been given. And also he should verify client's annual report, and he should check that whatever quarterly stock statements which are submitted by the client, they are matching with the annual report or not, that you need to check. So these are the auditor's considerations. Apart from that, the RBI has told that Banking Regulation Act says that, see, generally you can get the stock statement on the generally what banks will do is they will get the stock statement, on the basis of that drawing power can be determined. But in the recent times what happened is some big persons who have taken the loans from the banks, they used to submit fake stock statements. They're submitting fake stock statements and claiming excess drawing power. So that's why RBI has brought one policy. What they have told is, in case if the funded exposure is more than 5 crore rupees, what? In case if the funded exposure is more than 5 crore rupees, that means if the actual liability of a person is more than 5 crore rupees regarding working capital loan, then getting the stock statement alone will not be enough. The banker should do even the stock audit also. That means the banks will send some persons on their behalf, or the bank staff will go and verify whether really that much amount of stock is there or not. Able to understand? So when the stock audit will be applicable, not in all cases, only when funded exposure of more than 5 crores. Funded exposure means when actual amount utilized in the overdraft or cash credit facility is more than 5 crore rupees. They're receiving the stock statement alone will not be enough. The banker should even conduct stock audit as well. So that's what they're telling. The stock audit should be carried out by the bank for all accounts having a funded exposure of more than 5 crore rupees, and auditor can advise stock audit even in other cases also. Generally mandatory requirement when it is more than 5 crore rupees. But if the auditor finds anything suspicious regarding any account, he can ask the banker, sir, even though here the funded exposure is less than 5 crore rupees, still go into the stock audit. He can even ask the management to do in other cases as well. And even as a statutory auditor, even verify that stock audit reports and find whether there are any discrepancies. Understood, everybody? So these are all the reporting. This is what regarding audit of drawing power of advances. So I told you what is the meaning, how it is different from sanction limit, how it is, what are the bank's duties, and what is auditor's consideration, and what is stock audit. Clear, everyone? Able to understand till here? So coming to the next questions. So now, till now, if you could have observed till now, whatever questions we have seen, those are mainly talking about banks operations. You could have observed it. So we did not talk much about the audit of the banks till now, even though the chapter title is audit of the banks. As I've told you in the beginning itself, this chapter is going to talk very little about audit related matters. Mainly, it is going to talk about operations of the bank. So now actually from question number 8, some audit related questions will be there. So first, as you could see, provisions relating to appointment of auditors of bank. Who will make an appointment of auditors of the bank? First of all, sir, who is eligible, what qualifications, what disqualifications, everything like same like company auditor. So whatever qualification, whoever is eligible to act as a company auditor, same person will be eligible to act as an auditor for the banks also. Whatever qualifications, disqualifications which are applicable for a company auditor under section 141 of the Companies Act, the same qualifications and disqualifications will be even applicable for auditor of the banks as well. Sir, now who will make an appointment of auditor? In case of SBI, the auditor will be appointed by C and AG of India after consultation with the central government. So if it is SBI, C and AG in consultation with central government. Whereas for subsidiaries of SBI, auditor will be appointed by SBI. For SBI, C and AG will appoint. For subsidiaries of SBI, SBI will appoint. In case of other than SBI, whatever other nationalized banks are there, in those cases, board of directors will make an appointment, but after getting approvals from RBI. Similarly, in case of RRBs also, board of directors will make an appointment after getting approval of central government. Apart from this, whatever other banking companies are there, like ICICI Bank, Axis Bank, in all those cases, the shareholders will appoint the auditors at the AGM. Nothing but normal Companies Act provisions will become applicable. So these are the people who are having the power to make an appointment of auditors of bank. So now who will decide remuneration? In case of nationalized banks, SBIs and RRBs, the remuneration of the auditors will be decided by Reserve Bank of India after consultation with central government. So in all these nationalized banks, SBI and RRBs, who will decide the remuneration? RBI is only going to decide. That decision will be final, but RBI will decide the remuneration after discussing with central government. Whereas in case of all other banking companies, the remuneration will be decided by the shareholders as per sections 142 of the Companies Act, which means shareholders will decide the remuneration of the auditors. Sir, what will be the powers of the auditor? Whatever powers of the company auditors are there, the same powers will be there even for the bank auditor as well. Understood? And here we have one more concept. Sir, what are the matters which the engagement team members discuss while conducting the bank audit? See, not just a bank audit, while conducting any audit, engagement team members generally at the planning stage, they will have a discussion. Not just in the bank audit, in every kind of audit, initially at the beginning of the audit, mainly during the planning phase of the audit, all the engagement team members will generally have some discussion. Sir, what kind of matters they will discuss? They will discuss matters like errors that are more likely to occur. What are the chances of which kind of errors are more likely to occur, and what are the errors which have been identified in the previous year? In previous years, what errors were identified? They have a chance of getting repeated in the current year. And also, what are the different ways in which fraud can be committed in the bank? That also they will discuss. And need to maintain professional skepticism. They will discuss the importance of maintaining the professional skepticism in the bank audit, and how to respond to the risk. If you find any risk, how to respond to that. And they will also discuss the importance of remaining alert to circumstances that indicate a material misstatement could have occurred. So generally at the planning stage of the audit, all the engagement team members will have a discussion regarding these matters, which are errors that are more likely to occur or errors that have already taken place in the past, methods by which fraud can be perpetrated, need for maintaining professional skepticism, how to respond to the engagement risk, and need to remain alert to the risk of material misstatement. All these matters will be discussed in the meeting. And what are the advantages of having this discussion? Why do they have these discussions? Because it will provide an opportunity for more experienced team members to share their knowledge to the less experienced team members, and even it will promote better understanding among the engagement team members. And also specifically during the discussion, main attention they will put to banks financial statement susceptibility to fraud. Mainly they will focus on fraud, how to respond to the fraud. These will be the key matters which will be discussed during engagement team discussions. Clear? So this is what regarding engagement team discussion. Then we have one more question: overview of conducting overall bank audit. What will happen in the bank audit? Just a overview they will give. They will not talk in a detailed manner. Overview they are going to give regarding how to conduct a bank audit. So as you could see, first you have one of the preliminary engagement activity in any other audit. Before we accept the audit, we communicate with the predecessor auditor, right? Even we have seen in the preliminary engagement activities also, one of the preliminary engagement activity, first if you are accepting an audit for the current year which has been previously held by another auditor, first you have to communicate with him in writing. Here also the bank auditor, before he accepts the current year's audit, he will try to communicate with his predecessor auditor, and he will perform procedures relating to acceptance and continuation of client relationship. Four factors he will consider: integrity of the principal owners, evaluation of the competence of the engagement team, and also compliance with the ethical requirements, and significant matters that have arisen during previous audit engagements. That acceptance and continuation of client relationship also he will do here. And declaration of indebtedness, specifically in the case of banks, before you get appointed as an auditor, you have to declare a indebtedness. That means how much you are indebted to the bank. In case, are you indebted to the bank? If yes, for how much amount? Is your account classified as NPA? That written declaration you have to give. And terms of audit engagement, nothing but draft your engagement letter. Then internal assignments, you should not do any kind of internal assignment in case if you are getting appointed as a statutory auditor. And finally, establish your engagement team, determine who and all will form part of your engagement team. So these are all some basic initial considerations. Then after you are done with all these initial considerations, the first procedure which we will perform will be what? Risk assessment procedure. In risk assessment procedures, what we will do, we will get to understand the entity, its environment, including internal controls. That we do it here even in the case of bank. Then we will discuss, then we will have engagement team discussion. What discussions you will have? Just now we have seen it in the previous question that engagement team discussions also will take place. Then you will work on designing the audit plan, audit strategy, and also you will determine materiality. What is material, what is not material as per SA 320, determine the materiality levels, consider whether going concern is appropriate for the bank, and also particularly determine what is the risk of fraud, including money laundering. So you have to particularly see this in the case of bank. RBI has given framework like know your customers to avoid the money laundering. So as an auditor, we need to verify is there any risk of happening of money laundering in the case of the bank. And we have to maintain professional skepticism. We have to maintain a questioning mind. We should not believe anything whatever comes to our mind, whatever comes to our notice. We have to question that. And specifically we need to do two extra things. See, till now whatever we have discussed, that we do in every audit. But point number 9 and point number 10, this we do only in the case of bank audits. What is that special things which you do in the audit of banks? Number 1 is checking the stress testing framework, checking the Basel III framework. Sir, what is the stress testing framework? Framework means what? Nothing but, as I have told, rules and regulations. See, RBI has given a set of rules and regulations and gave it a name, stress testing. Sir, what is this stress testing framework? Nothing but the banks has given, RBI has given certain rules and regulations which every bank has to follow. If they follow that, they will be able to withstand the recessions. If at all any economic collapse happens, banks should be able to withstand it. Banks also should not collapse. So in order to make the banks strengthen, RBI has given certain rules and regulations and gave it a name called stress testing framework. So as an auditor, our responsibility is to check whether bank has really complied with that requirements of the stress testing framework or not. That we need to check and give a comment on that as well. So that you need to do stress testing framework. You have to check compliance with the stress testing framework. Then you then even you need to check the compliance with Basel III framework. Sir, what is this Basel III framework? Basel III framework is also nothing but certain rules and regulations. But the difference between stress testing framework and Basel III framework is stress testing framework is a national level framework given by RBI. Whereas Basel III framework is a global framework which will be followed all over the world, not just in one country. Basel III framework contains rules and regulations which will be followed all over the world. It is given by a committee called BCBS. BCBS means Basel Committee on Banking Supervision. So like that, a global committee has given that framework. Whether the requirements of that Basel III framework are also complied or not, that also I need to check. And finally, you have to verify other auditors' reports. If any other reports are there in the bank, you have to go through that reports as well. That could be previous year's audit reports, that could be inspection reports by the higher bank officials like head office officials. If RBI has done inspection, check that inspection report. If internal audit department is there, verify that internal audit report, internal auditors report, and report on verification of security or any other internal report which is available. Please read that internal report to find out whether there are any adverse comments relating to functioning of the banks. So this is what we basically do in the overall audit of the bank. So as we have seen, they are not talking about in a detailed manner, just they have given an overall view what exactly will happen in the audit of banks from beginning till the ending. Clear, everybody? So the next set of questions will be dealing about how to conduct audit of each and every item of the financial statements. So as we have seen, question number 10 actually talks about what is the overview of the entire bank audit from the beginning till the ending, what and all we are going to do. They have given an overview, they have given a brief. Now we will see a set of questions which will be talking about how do you particularly verify the advances of banking company. Then we will have one question talking about how do you conduct audit of incomes of the bank. Then we will have one question, how do you conduct audit of the expenses of the bank. So now they are going to go into detail. They are going to take up each and every major item of the financial statements and how specifically we are going to verify that major item, what things we are going to keep in mind, that they are going to talk about it. So first let us start with question number 11, which is talking about as an auditor, how do we verify the audit of income, audit of advances of a banking company. As we know, if you open the balance sheet of a banking company, the major asset will be what? Loans and advances which are given by the bank. So as an auditor, if you are conducting audit of any banking company, the significant portion of item of the financial statements, the significant portion of balance sheet will contain advances. How are you going to verify the advances? What things you will try to keep in mind regarding that advances? So first of all, we need to see that the advancing facility which is done by the bank can be divided into two categories. Number one is funded advances. Number two is non-funded advances. Funded loans are those loans which involve actual outflow of the funds. For example, if you go and take a housing loan from the bank, will the banker give you funds? Yes, the banker will give you the funds. If you take a personal loan, will the banker give you funds? Yes. So not all facilities are funded facilities. Some facilities could be even non-funded facilities also. Sometimes bank will give advancing facility in the form of giving a bank guarantee. So when the bank is giving a bank guarantee, there will not be any outflow of funds from the banker. Just a bank will stand as a guarantor. So whatever advancing facilities which the bank has given, they will be broadly divided into two categories: funded advances and non-funded advances. Funded advances are those advances which involve actual outflow of the funds, whereas non-funded advances are those advances which does not involve any actual outflow of the funds. And the Banking Regulation Act says that as an auditor, if you are conducting audit of the bank, whatever large advances are there, that you verify 100%. You have to verify all large advances, and whatever other than large advances are there, that you have to verify on sampling basis. So the rules and regulations say as an auditor, you need to verify all large advances. Whatever other advances are there apart from large advances, that you can verify on a sampling basis. Sir, how to determine which advance is a large advance? What is the criteria for large advance? So we have to remember one thing. There is no hard and fast rule. So it is purely upon the professional judgment of the auditor. Whether an advance will be large advance or not, that is purely depending on the professional judgment. So the auditor, keeping in mind the size of the operations of the bank, the volume of the operations of the bank, they have to decide which advance will be large advance. They will decide the criteria. However, one example they have given in the study material, they said that an advance may be considered to be a large advance if the year-end balance is in excess of 10 crore rupees or 10% of the aggregate year-end advances, whichever is less. So make this small correction in the material. So initially you might find 2 crores or 5%. Just make a small change. So it will be either 10 crores or 10% of the aggregate year-end advances of the branch, whichever is less. This could be criteria. However, I am telling this is only example. This is only example. So if it is an example, even we can keep the same thing also, 2 crores or 5%, or you can say 10 crores or 10%. So whatever we want, we can put the limit. So, but ultimately, which advance is a large advance, which advance is not a large advance, that is purely depending on auditor's professional judgment. Clear, everybody? So just here it is an example. Maybe some auditor might set a criteria that any advance which is exceeding 10 crores or 10% of the aggregate year-end balances, whichever is less, that I will consider it as a large advance. An auditor can put that criteria, but it is not a hard and fast rule. It all depends on the auditor's professional judgment. So all large advances, whatever criteria, on the basis of criteria, whatever you have decided, all large advances you verify on 100% basis. Other than large advances, whatever are there, that you try to verify it on sampling basis. So whatever it is, either on 100% or sampling basis, what specific things we need to verify regarding advances? First, we will do some preliminary examination, basic examination we will do. Sir, what will get covered in the basic examination? Number one, see, before a banker is giving a loan to any customer, did they check the credit worthiness of the borrower? Creditworthiness means what? Repaying capability. Has the banker checked the repaying capability of the borrower? Then only loan has been sanctioned or not. And also obtain sanction. Is there a proper approval from the concerned authority? So generally branch manager should give the approval. So check that whether loans and advances have been given only after getting approval from concerned authority and all necessary documents have been executed. So whenever you go to the bank and take a loan, they will make you sign a bulky documentation. They will make you sign 30-40 pages. So that is nothing but loan agreement. So that is very important. Why? Because in that agreement, clear terms and conditions will be there. What rights banker will have in case if the borrower repays the loan, all the terms and conditions will be there in the agreements. So we need to check as an auditor whether all that documents are properly executed or not. So this basic examination we have to do. Number one, checking the creditworthiness of the borrower. Number two, checking whether the loan has been given under proper sanction. Number three, all necessary documents have been executed or not. So this basic examination I have to do. Then I have to verify some aspects with regard to security. What things I need to check regarding security? Number one, whether all the securities are registered in the name of the bank. Whatever securities banker has accepted, that asset should be registered in the name of the bank. In case if the shares and debentures are given as security, the ownership will get transferred to the banker. Once the customer repays the loan, the shares and debentures will be transferred again to the borrower. And always sufficient margin has to be maintained. I already told you what is sufficient margin. The excess of that security value over the borrowing amount, that we call it as margin. There should always be margin, not just at the beginning. Throughout the tenure of the loan, there should always be sufficient margin in every loan and advance. And in case if the goods are in the possession of the bank, for example, this will happen in the case of pledge. In case of pledge, banker will get the possession of the security. No, in case the banker is having the possession of that goods, they have to check the contents of the package and the go downs should be frequently inspected. Why? Because if tomorrow borrower comes and repays the loan, you have to give back his assets. So you can't say we have lost it, assets are damaged. You can't say that. So whatever goods the borrower has given to you as a security, they should be kept under safe custody, and wherever these goods are getting kept, they should be frequently inspected. Now, then certain things you need to verify regarding drawing power. So nothing but in case of short-term loans and advances, you need to even verify some aspects relating to drawing power. What things you will check regarding drawing power? So drawing power register should be updated every month. Every month the drawing power register should be updated. And also all the accounts should be kept within both drawing power and also sanction limit. No account should exceed the drawing power or sanction limit. And in case if you find any account which is exceeding the drawing power or sanction limit, that should be immediately brought to the notice of the controlling authority like head office or RBI. You have to immediately bring it to their attention. So these are the few basic things which we need to verify regarding loans and advances. Similarly, we will have one question which is talking about how do we conduct audit of incomes of the bank. Now they talk about different incomes here. So one of the major income is interest income. One of the major income is interest income. So they say that how the interest income should be recognized. How interest income should be recognized? Generally, interest income should be recognized on accrual basis. However, if an account is classified as NPA, then interest income should be recognized only when it is received. That is on cash basis you have to recognize when an asset turns out to be NPA. The same thing they try to say here, policy for income recognition in respect of NPS. Generally, in respect of NPS, the interest should be recognized on the basis of record of recovery. That is, income will be recognized only when received, not when it is accrued. Exception. However, if the loan has been taken against the deposits of term deposits, NSCs, KVPs or IVPs, even though they remain overdue for more than 90 days, they will not be classified as NPA. They will remain under standard category only, and even income also will be recognized on accrual basis only. Here one important point I want you to revisit, which is very important for examination. See, we have seen two cases. In case if the central government guaranteed advances are there. In case if the central government guaranteed advances are there, even though they remain overdue for more than 90 days, still they will be treated as standard only. For asset classification, they will be treated as standard assets. That means they will not be treated as NPA. So for asset classification, they will remain under standard category only. But for income recognition, they will be treated as NPA. Which means what? Income will be recognized on cash basis. Income will be recognized only when received on cash basis. This is in which case? In case central government guaranteed advances are there, even though they remain overdue for more than 90 days, they will remain under standard category only for asset classification, but income will be recognized only when received. That is on cash basis. However, in case if the loans are taken against FDs, term deposits or fixed deposit, both convey same meaning. So in case if the loan has been taken against term deposits, NSCs, KVPs or IVPs. In case if the loans have been taken against term deposits, NSCs, KVPs or IVPs, even though they remain overdue for more than 90 days, still they will not be classified as NPA. They will remain under standard category only. Standard category. For asset classification, they will remain under standard category only, provided sufficient margin is available. If sufficient margin is available, even though it remains OD for more than 90 days, no need to classify it as NPA. But here, income recognition also, we will treat it as standard only. That means income we can continue to recognize on accrual basis, no need to recognize on cash basis. Clear, everybody? So very important, this point they can test you in the examination by way of MCQs, etc. So we have to be a little bit cautious here. Once again, I'm summarizing. In case of central government guaranteed advances, for asset classification it will remain in standard category, but income recognition we treat it as NPA. That means on cash basis we recognize. But however, in respect of loans taken against term deposits, NSCs, KVPs or IVPs, for asset classification also it will remain under standard category, and even for income recognition also will treat it as standard. That means we will recognize the interest income on accrual basis only, need not be on cash basis. But however, the condition for this both is there should be sufficient margin available. Always sufficient margin should be available. That means there should be some excess amount in the value of the security than the borrowing amount. Clear? Next one. So the same thing they say there. Reversal of income. And one more thing they say, in case if the account turns out to be NPA, not just we will stop accruing the income which has already been recognized but not yet realized. See, if an account turns out to be NPA, going forward we'll stop accruing income. But what about the income which is already recognized? The income which is already recognized, if it is realized, okay, you recognized it and also you have received it, well and good. But in case if the income has been recognized but not yet realized, account already turned NPA, going forward you will stop accruing the income, but you have already recognized some income but not yet received it, then the government is telling, then the Banking Regulation Act says reverse that unrealized income as well. So if any advance becomes NPA, the entire interest accrued and credited to income account in the past periods should be reversed. When? If it is not realized. If it is realized, well and good, no need to reverse, ignore it. But if you have recognized it but not yet realized it, then compulsorily you have to reverse it back. Then, so even though you will reverse all that income, but for control purposes, you will keep it in a separate memorandum account. Some control account you will open. In that, you will try to maintain that record of income reversed and income stopped being accrued. So that we will try to keep it in a memorandum account for control purposes. From the main books, we will take it off, but we will maintain one memorandum account. There we will maintain the details. And sir, what if there is a partial recovery in NPS? What if there is a partial recovery in NPA? I will try to explain what is this partial recovery. Take for example, there is one account. The bank has given one loan. In that, principal outstanding is 10 crore rupees. Interest outstanding is 2 crore rupees. But this particular borrower, whoever has taken this loan, he has gone bankrupt. As a full and final settlement, 6 crores has been received. As a full and final settlement, only 6 crores has been received by the bank as a full settlement for the entire 12 crore rupees. Now the thing is, whether this 6 crore should be treated as recovery of principal, or it should be treated as recovery of interest, or it should be treated in some ratio. Whether this 6 crore rupees as full and final settlement should be treated as principal repayment, or should we treat first as interest payment and balance for principal repayment, or we have to apportion it between the two. What should be done? How we have to treat it? See, generally, how to treat this partial recovery, it will depend on the loan agreement. Generally, in the loan agreement, the terms and conditions regarding this will be clearly written. So in the loan agreement, if they are telling whatever partial recovery you are receiving it, in case if you have received partial recovery, first treat it as interest, balance you treat it as principal. That only they will follow. In case if in the loan agreement it was written, if you are making partial recovery, first treat it as principal, and if anything is left out, then you treat it as interest recovery. Or if in the loan agreement it was told you have to apportion it in some ratio, you have to consider that. So generally in the loan agreement there will be a clause talking about what is the treatment in case of partial recovery. In the loan agreement there will be one particular clause. We have to follow the requirements of the clause. Sir, what if in this particular case in the loan agreement this clause is missing? Generally it will not happen. Today all the loan agreements are standardized. In every loan agreement there will be compulsorily a clause. See, generally today loan agreements are all pre-printed information. So they will not sit and discuss with you all the terms and conditions. There will be pre-printed format will be there, just you are required to sign. So generally clauses will not miss. But a hypothetical scenario they are telling. In this particular case only for this customer, in the loan agreement this clause is missing. Then what needs to be done? See, if it is missing in this loan agreement, in other loan agreements it will be there. No, generally every bank will have uniform policy. So whatever you are following in the other loan agreements, same thing you regularly imply it here also. Understood? So in case if in the loan agreement clearly this recovery clause has been given, follow that. In case if it is not given in that particular loan agreement, follow whatever you are doing in the case of other agreements. But generally, as I have told, this thing will not happen. Why? Because today all the loan agreements are standardized. There is no chance of missing off any of this clauses. Clear? Sir, why it is important if you have made a partial recovery? Why it is important to know whether it is recovery of principal or interest? Why it is important is, if you treat it as recovery of interest now, previously you would have reversed it or you would have stopped accruing it. But since now you have received it, now in the statement of P&L you have to recognize this interest income. That's why. So if you treat it as recovery of interest now, earlier you would have reversed it. Earlier you would have stopped accruing it. But now you have realized it. No, now you have to recognize that interest income. So that's why it is very important to know whether in the case of partial recovery, is it recovery of principal or is it recovery of interest? Clear, everybody? Next one. Then they talk about bill discounting income. See, in the bill discounting income, they specifically say only one thing. So what is that bill discounting income is? Generally, for example, assume that there is one bill which is discounted on 1st of April 2020, 1st of March 2024. There is a bill amounting to 1 lakh rupees and the banker has collected 9,000 rupees of discounting income. Total discounting income they have collected is 9,000. But actual maturity date of the bill is 31st of May. Generally, the bill's due date is 31st of May, but one customer came to the bank and he discounted the bill. For discounting that bill, banker has collected the income of 9,000 rupees of discounting income they have collected. Now, how to recognize this 9,000 rupees of bill discounting income? Should I recognize all at once or should I recognize it over the tenure of the bill? The bill discounting is nothing like a financing activity only. So the Banking Regulation Act says, in case if you have a bill discounting income, that bill discounting income should be recognized over the tenure of the bill, not all at once. So now what will happen is, this bill tenure is 3 months. So 1 month will fall in the financial year 23-24. Till 31st of March 23-24, it will be financial year 23-24. 1 month of the bill tenure is in 23-24. 2 months of the bill tenure is in 24-25 financial year. So out of this 9,000 rupees of income which the banker has collected, only 1 month's income, that is 9,000 rupees into 1 by 3. 3,000 rupees of bill discounting income only will be recognized in 23-24. What about that balance 6,000? How we should show that as on the balance sheet date? How the management should show this item in the balance sheet date? As on in the balance sheet, how they have to show this? 9,000 income they have received, but 3,000 only they have recognized. What about the 6,000? How they have to show it? Income received in advance will become what? Liability. They have to show it as a liability as on the balance sheet date, and that balance 6,000 they can recognize in the financial year 24-25. Understood? Next, they also talk about bills for collection income. They also talk about bills for collection income. See, bills for collection is not a discounting facility. Bills for collection is not a financing activity. It is an outsourcing activity. So in case of bills for collection, you need not recognize that bills for collection commission or the tenure of the bill. Whenever you receive that commission, then you can recognize that entire income in the statement of P&L. What is bills for collection, bill discounting? I hope you know the difference. Bill discounting is financing activity. Bills for collection is an outsourcing activity. So in case of bill discounting, generally what will happen is the banker will give the funds well in advance, later he will collect. But in the case of bills for collection, first banker will collect the payment from the third party, he will deduct his commission, the balance amount will be transferred to the customer. For example, one company has sent 1 lakh rupees of bills for collection, the banker will collect it, take for example 2% of commission, 2,000 they will keep, 98,000 they will give it to their customer. So this commission, bills for collection commission, when they will recognize? As and when they receive, then they will recognize. Is there any requirement to apportion it over the tenure of the bill? No need to apportion it. Entire income you can recognize it as and when received. Why? Because it is not a financing activity, it is just a outsourcing activity. Then income, then few more things they say. Income from rescheduling or renegotiation of the loans. Sir, what is this? What is this income from rescheduling or renegotiation of the loans? See, take for example, there is one customer who has taken the loan. The actual due date is 31st of March 2024. He has to repay the loan on 31st of March 2024. But on this day, before this date, the customer approached the banker and told, sir, I am not in a position to repay the loan on 31st of March 2024. I have a request. Please extend my loan till 31st of March 2026. I want you to extend the due date on my loan for 2 more years. Sir, will the banker do it? In some circumstances, they might do it. It might be in the interest of the banker. Sometimes bankers will agree to it. Now, for increasing this due date, what they will do is, for this extra 2 years, they will get interest income. For extra 2 years, banker will get interest income. But in addition to that, the banker will charge some other income also. In the name of processing charges, in the name of some other fees, what they will do is they will say, sir, we will extend the due date by 2 more years. For this 2 years, you have to pay interest. Along with that, since we are extending the due date, for that, there will be a processing charges of 1 lakh rupees. What the bankers will collect? They will collect some one-time income for renegotiation of the loan, rescheduling of the loan in the name of processing charges or whatever you call it. See, this rescheduling income will be in addition to the interest income for that extended period. So here the banker has collected 1 lakh rupees saying that it is a income for, it is a charges for extending the due date. Now this we call it as rescheduling income or renegotiation income. How to recognize this? Can I recognize all at once? No. The Banking Regulation Act says you have to recognize this rescheduling income over the period of that rescheduled term. For how many years the loan has been rescheduled? For 2 years. This entire 1 lakh rupees of income should be recognized over the period of these 2 years, not all at once. Clear? So this is what they say there. And income from investments, and if the bank is having any excess funds, they will also go and make the investments. So we have to check that all the investments from that government securities, bonds, and investments by way of interest and dividend, everything has been properly recognized or not. That also we need to check. And the bankers will also make the sale of these investments. We have to check whether that sale on the profit or loss arising on the sale of investments has also been taken to the statement of P&L properly. And sometimes they do revaluation of the investments also. We need to check whether that revaluation income has also been taken to the statement of P&L as per the directions of RBI. So even from investments also you need to verify this. Clear, everyone? So now we have one more thing, reversal of income. Very short question. In what circumstances you will reverse the income? I have already told you. So in case if the account turns out to be NPA, whatever income, whatever interest income which you have already recognized but not yet realized, you have to reverse it. So as I've already told you, when an account turns out to be NPA, going forward, we'll stop accruing the income. But whatever income that we have already recognized, if it is not yet realized, that also we have to reverse it back. And they say here one more thing, not just interest income, even you have to recognize any other income. Not just interest income, any other income in the name of processing charges, etc., which has been already recognized by the bank. But if it is not yet realized, even that all other kinds of incomes are also required to be reversed. So the same thing they say here. First, if any advance turns out to be NPA, not just we will stop accruing the income, whatever income that is already interest income, whatever it is recognized, that also should be reversed if it is not realized. Not just interest income, any other income in the name of fees, commission, or any other similar income in respect of accounts which have turned out to be NPA, that income is also required to be reversed if not yet realized. And what is one more case where we will reverse the income? Generally, when any income has been recognized by mistake, when any income has been recognized by mistake, then also bankers should reverse that. So for example, you have wrongly recognized income in this year, in the same financial year, if you find out that mistake, you can reverse it. But sometimes what will happen is you have wrongly recognized income in 1 year, in the next year you have recognized that mistake. Then what you should do? You have to create a provision for that. You have to charge it as a expenses. So in case if you have recognized income in the same year wrongly and in the same year you have identified, then we can reverse it. But if you recognize it in the future years, we can't go back to the prior years and reverse it. We have to create a provision for the same. So this is what regarding reversal of income. Able to understand, everybody? So similarly, they talk something about how do you verify audit of expenses. What briefly we try to verify. They are giving us a brief. How do we verify expenses of a bank? As we all know, what is a major expense? The major expense in the case of bank will be interest expense. Sir, how do you verify interest expense? First, they say they will ask you to perform some analytical procedures. Sir, what analytical procedures they are asking us to do? So what they will ask you to do is calculate some weighted average interest. That means they will ask you to do two kinds of comparison. Compare within the same year, compare even with the previous year. So what comparisons you will do? In the case of same year, you will calculate weighted average rate of interest for a category of loan. Take for example, if you are calculating term deposits, the banker has to pay interest on term deposits. The banker will calculate weighted average rate of interest on entire term deposits. They will get certain percentage. For example, they got some 6%. Now this weighted average rate of interest should be compared with interest rate on each and every deposit. For example, on one particular deposit, the interest rate was 5.8%. Okay, close range. For another deposit, the interest rate was 5.9%. Okay, close range. But they are able to find that for one particular fixed deposit, the interest rate is 4%. Huge deviation. Weighted average is 6%, but you have got only 4% on one particular deposit. Since you find a huge deviation, you will try to investigate that further. So this kind of comparison you will do. So you will calculate weighted average rate of interest and then compare this rate with actual average rate of interest paid on each deposit. And if you find any deviation, you will try to inquire it. Similarly, you can do the comparison with the previous year also. In the previous years, what you can compare is, for example, for the term deposits, I will calculate what is the average rate of interest in the current year. And also I will calculate in the previous year what is the average rate of interest in the for the term deposits in the previous year. I will compare both the averages. If I find any huge deviation, I will try to investigate that further. So like this, the first thing to check whether interest expense is reasonable or not, they will ask you to perform some analytical procedures. So you have to calculate this weighted average rate of interest and do some comparisons within the same year and do some comparisons with the past year. Apart from that, we need to check that interest has been provided on all deposits up to the date of the balance sheet. And for interest, there will be some rules given by the RBI. RBI will give some rules. We need to check that interest has been paid as per the rules given by RBI. In case of fixed deposit, the banker will give you fixed deposit certificate. On that fixed deposit certificate, rate of interest also will be mentioned. You have to take a sample of fixed deposits and calculate that interest has been paid as per the rate prescribed in the fixed deposit certificate. And also in case of inter-branch balances, sometimes between the balances funds transfer will happen. SBI branch of Hyderabad may give funds to the SBI branch of Mumbai. This we call it as inter-branch balances. Even on the inter-branch balances also interest will be charged as decided by the head office. Clear? So these are the few basic things which we need to check regarding interest income. Then we have interest expense. Then apart from that, we have various other expenses also. Interest will not be the only expense. There will be various other expenses, like they have to pay staff salaries, they have to pay office rent, they have to pay maintenance, they have to pay housekeeping services, they have to pay for security. So many other expenses also will be there. They have collectively given a name operating expenses, and they have given some common points which we check for all other operating expenses. Number one, we need to check whether there is a proper internal control mechanism for all other operating expenses, for salaries, for office expenses, for maintenance. For all this, proper internal control system is there or not. And wherever we have supporting documents, you have to check the supporting documents. Number three, wherever possible, wherever you find that there is a relationship, you need to even perform analytical procedures. So they have referred to all other expenses as operating expenses. They have told three common things which we are supposed to do. We have to check whether there is proper internal control mechanism. Wherever supporting documents are there, check the supporting documents and even try to perform analytical procedures in case if any relationship exists. Apart from that, next major expense in the case of banks will be provisions. And in that provision also, main provision will be provision in respect of NPAs. Banks are required to make the provisions in respect of NPAs. So we need to check first whether asset classification has been done correctly. And for each asset classification, the rate of provision is also given under Banking Regulation Act. So we need to check that first, asset classification is proper or not. And also whether whether for each category of asset, the rate of provision has been as prescribed by the RBI rules and regulations or not. These two things we have to check. Then apart from provision in respect of NPAs, the next bigger provision will be provision for tax. How do we verify provision for tax? See, being a chartered accountant, we also know the tax provisions. So what you can do is you can calculate the tax liability on your own, compare it with the management's calculation, check whether both are matching or not. And apart from that, whatever other provisions are there, like provision for warranties, etc., we need to check for what circumstances these provisions are created and whether those provisions are adequate, whether that provisions are enough, whether they are not overstated, they are not understated, that we need to verify it. So these are the few things which we need to verify regarding provisions. So we have covered what things we need to check regarding interest expense, what things we need to check regarding operating expenses, and even we have seen what things we need to check regarding other provisions also. Till here, everybody comfortable? So now we will try to talk about reporting requirements. Since we have seen how to conduct audit of advances, how to conduct audit of incomes, how to conduct audit of expenses. So now we will have a look at what will be the reporting requirements of auditors of bank. In case if you are conducting audit of a bank, what and all reporting requirements will be applicable, to whom you are required to report, how many reports you are required to submit, all that we will see. See, practically speaking, in the case of a bank, reporting requirements are very high. In the case of normal audits, if we give one audit report, that will be enough. But in the case of the banks, numerous reports are required to be given. Let us see what are they. So in case if you are conducting audit of a nationalized bank or SBI, you are required to submit a report to the central government. When? Only when you are conducting audit of a nationalized bank or when you are conducting audit of SBI, then you are required to make a report to central government. In that, what you have to mention, let us see. In case of nationalized bank and SBI, the auditor is required to make a report to the central government in which he must state the following. So that report which you are sending to central government, you must state these things. What are they? Number one, whether balance sheet and P&L and all the necessary particulars and is properly drawn up and exhibited true and fair view. Nothing but simply whether the financial statements are giving true and fair view or not, that you have to give a comment. Next, whatever explanation information is required for him, whether he get all the information and explanation that you have to comment, and whatever transactions which the bank has done, whether they are within the powers of the bank, that the bank did not do any transaction going beyond its powers, and whether you have whether you have received all the returns from the offices and branches and you have found them adequate for the purposes of your audit. Did you receive all the returns and reports from the branches, and are they adequate for expressing the opinion on the entire company? So in case if you are conducting audit of a nationalized bank and SBI, you have to submit a report to central government. In that report, you have to state on 4 things: whether financial statements give a true and fair view, did you get all the information and explanation, whether the transactions of the bank are within the powers of the bank, and did you receive the returns and reports from the branches, and are they adequate for the purposes of your audit. And in addition to that normal audit report, you have to prepare what should be the format of the report. You have to prepare the report as per standards, nothing but 700 series of standards you have to follow. Even in the case of audit of banks also, audit reports of banks also, you have to prepare that audit report as per standards on audit. And in your audit report, you are required to give one more disclosure. In the if you are a central statutory auditor, in the audit report which you are giving for the bank, you have to add one more disclosure. So what is that disclosure is, take for example, if you are the principal auditor of SBI. So if you are auditor of a SBI, you are giving audit report on entire SBI. What you should state in your SBI, what you should state, extra state in your audit report is, you have to find out of entire branches of SBI, are there any unaudited branches? Are there any unaudited branches? You have to find it out. So for example, as an auditor, I came to know that out of this entire SBI's audit, there were some 10 branches which were unaudited. There were some 10 branches which are unaudited. I have to mention in my audit report, there were a total of 10 branches which were unaudited. Not just mentioning the total number of branches, even you are required to report for these 10 branches put together, what are the total advances, what are the total deposits, what is the total interest income, what is the total interest expense for these 10 unaudited branches. That amounts also you are required to mention in your audit report. That amount also you are required to mention in your auditor's report. So let me read this very important point. The auditor should ensure that not only information relating to number of unaudited branches is given, but quantification, that is amount of advances, deposits, interest income and interest expense for such unaudited branches is also required to be included in his audit report. So this is what is required to state. If you are a principal auditor giving the audit report on the entire bank, you have to identify how many number of branches of the entire SBI were unaudited, and what is the amount of total advances, deposits, interest income and expense in respect of that unaudited branches you are required to mention in your audit report. But I have a doubt, in which paragraph you will report? Okay, the rules are telling you are required to report regarding this information, but in which paragraph you will tell this report? You will tell this information. Generally other matter paragraph. Why? Because we use other matter paragraph for responsibility related matters. No, so this is a disclosure regarding responsibility related matter, so we can happily discuss that in the other matter paragraph. So whatever it is, this extra disclosure is required to be given. In addition to that, even you are required to report on the matters specified under 143 of the Companies Act. Like under 143 subsection 1, we have 6 matters which are required to be reported. Under 143 subsection 3, we have a total of 9 plus 6, 15 matters which are required to be reported. And under 143 subsection 11, we have CARO, the total of 21 matters. Are you required to report this in the case of bank? No, CARO will not be applicable in the case of banks. In the banking company, CARO will not be applicable. So only reporting requirements under 143 subsection 1 and reporting requirements under 143 subsection 3 will be applicable. The reporting requirements under 143 subsection 11, that is CARO, will not become applicable in the case of bank. So CARO will not be applicable. In addition to all this, the auditors of banks are required to submit one more report which we call it as LFAR, long form audit report, also you are required to submit. So this is required to be given in the case of all bank audits. And which matters, sir? Those matters are already prescribed by RBI. What things are required to be included in LFAR, that is already prescribed by RBI. So on that matters you have to report, and even there is a timeline for submitting that LFAR. The LFAR is required to be submitted before 30th of June every year. You have to submit that. There is a timeline also. So main report you have to give. In case if you are conducting audit of a nationalized bank or SBI, you have to report to central government. In addition to that, LFAR is also there. In extra to that, even you are required to report on fraud also. In case if you find any fraudulent activity in the functions of the bank, you will fulfill the reporting requirements under 143 subsection 12. Reporting to central government will become applicable. In addition to that, in case if you found any fraud, even you are required to report to the RBI as well. The same thing they say there. So the RBI has issued a circular which says if an accounting professional, you only, you and me, So if an accounting professional, whether in the course of internal audit or external audit, if he finds anything susceptible to be fraud, or if he finds any fraudulent activity or an act of excess power, or if he smells any foul play in any transaction, then that accounting professional should refer the matter to the regulator. Who is that regulator? RBI. Any deliberate failure, in case if you make any failure intentionally, if you fail to report that matter to the RBI, you will be held liable, you will be punished. Even SA 240 also says that, and whatever reporting requirements as per SA 240 is there, that also you have to fulfill. SA 240 is actually the standard talking about fraud and related matters. This we will learn at the CA final level. This I will teach you at the CA final level. So even that reporting requirements under SA 250 also you have to comply. In addition to that, even you have to check the compliances with the laws and regulations as per SA 250. These two standards we will discuss at the CA final level. And in addition to that reporting of fraud to the RBI, even you are required to report the fraud to the central government under 143 subsection 12. Even that 143 subsection 12 reporting requirements also will be applicable. Clear? So these are all the reporting requirements. So these are all the major concepts, guys. So with this, I have covered the most important concepts from this Audit of Banks chapter. Hope you guys have understood this chapter, Audit of Banks.